All right, hello class, thank you so much for joining me today. So today is going to mark the first lecture of our second unit in this class, which is going to be focused on labor demand and labor market equilibrium. So up until now, we've thought about labor supply, which is to say we've thought about how many hours people are going to be willing to work and whether people are going to work at all as a function of things like their preferences for leisure and consumption, but also the wages that they're offered, taxes that they're subject to, and the provision of government benefits that might change people's incentives to work, right? Things like disability insurance and the earned income tax credit. So what we're going to be doing now is we're going to be looking at the other side of the market. We're going to ask how many workers firms are going to be willing to hire and at what wages, and we're going to be able to think about that as a function of things like the firm's technology, right? Changes in the productivity of workers, things like import competition, right? The value of the output that workers are producing, and things like government regulations that affect, for example, mandatory benefits for workers, how that's going to affect firms' decisions about who to hire. Once we've got both of these two sides of the market, we're going to mush them together and be able to think about competitive market equilibrium, which is going to allow us to think about things like how changes in immigration or other labor market changes are going to affect the overall market for labor, right? So we're going to be able to think about equilibrium dynamics that come out of changes in labor market environments, right? Changes in demand or supply of labor. So all of this is to say, if you thought this class is pretty cool so far, it's just going to get more amazing from here. Each unit is going to become more wonderful and more enjoyable than the one before. Wonderful. Okay, so before I dive in today, well, first of all, what the goal is specifically for today is to introduce some of the basic concepts around labor demand. So we're going to think about why firms demand workers, and we're going to think in fairly simple, short-run circumstances about how many workers a firm is going to demand as a function of their technology and prices. So the most important thing to start with when we're thinking about labor demand is the fact that while labor is supplied by human beings, right? Labor is supplied by people, labor is demanded by firms. And our understanding of firms differs in some pretty important ways from our understanding of human beings. So in general, right, we're comparing these two. Right? Got people versus firms. And the most important distinction we're going to draw between people and firms is we're going to say that whereas human beings are motivated by subjective preferences that are personal to the individual, firms, in our simplest understanding, are purely motivated by profit. In other words, people's goal, right, is to maximize their own subjective well-being, which we've called utility. Basically a meaningless term we've used to not take a stance on what people's well-being is about. Firms are going to maximize their profit, right, which is determined by prices, and this is objective. In other words, if I've got two individual human beings facing exactly the same set of options, right, with the same choices of leisure and consumption, they might make two totally different choices because they care about different things, right? One person likes to work more than the other. One person has a young kid in the house that they want to take care of or an elderly relative, right? There's all sorts of reasons that two people, given the same circumstances, are going to come to different conclusions about what's best. On the other hand, if we assume that all firms are just trying to maximize the number of dollars in their bank account at the end of the year, right, maximize their profits, we're going to assume that every single firm facing the same set of circumstances is going to make the exact same decision. And so, whereas we have utility functions, right, that govern individual people's decisions, firms are going to be governed by profit functions, which are going to be essentially a function of the price at which they can sell output, the price at which they can buy inputs. Okay. And then the other thing, right, the other crucial thing when we want to make decisions, both as human beings or as firms, is once we know our goals, we need to know our options. Human beings are constrained in their choices with budget constraints, right? Right? In an ideal world, you'd be frolicking in the Elysian fields with infinite leisure, infinite consumption, drinking ambrosia, right, playing harps. But in reality, you only have 24 hours a day. You can only get so much money for your time. You only have so much money from your uncle, right? And this is going to limit your set of choices. On the other hand, for firms, we're not going to have budget constraints. we're going to model firms as being able to hire as many workers and as much capital as they want without having to worry about, I only have $300, so how many workers can I hire? How many robots can I hire? What's my best combination of workers and robots that cost $300? However, firms are also going to be constrained, right? There's a reason that they can't just make infinite profit. And the way that they're going to be constrained is they're constrained by the limitations of their own production process. In other words, they've got a production technology or sometimes I'll use these interchangeably, a production function. Which tells them, given a certain amount of labor, given a certain amount of capital, how much am I able to produce, right? So their limitations, the reason they can't just get as much profit as possible, they are limited by the constraints of their own ability to produce output, right? Wonderful. Beautiful. So if we know that firms' goal in making their decisions is to maximize their profit, and what we want to understand, right, because we're labor economists, we don't really care about the firms, we care about the workers they hire. So if we want to understand how many workers they hire, all we have to do is we have to figure out how the hiring of workers is going to affect their profits, right? In other words, we need to understand the firm's profits, to understand the firm's decision making, so we can figure out how many workers they're going to hire. Wonderful. So in its simplest form, when we talk about profit, all we're saying is profit is the difference between your revenues and your costs, right? Right? Simple enough. Money that goes into your pocket minus the money that goes out of your pocket. And in our simplest form of a firm, if we're thinking about firms that are perfectly competitive, both in input and output markets, we're going to say, well, firms can hire as much labor, as much capital, right, as many inputs as they want. They can produce as much output as they want. They can sell the stuff that they produce at some market price. They can buy labor and capital at some market price, right? So for today, at least, we're going to imagine a very simplified version of a firm's decision-making process that abstracts away from anything like needing to find investors in order to increase the scale of production, needing to recruit workers in a costly way. All of that stuff goes out the window, right? So as a result, when we talk about total revenue and total cost, all this is going to be total revenue is just going to be the price times the amount of stuff we're going to produce, which I'll call Q, and total cost is going to be the cost of my inputs. So if my inputs are labor and capital, that's just going to be the wage that I pay workers times the number of workers plus the rental rate that I pay my capital times the number of units of capital. Wonderful. Okay. So all we need to figure out now, right, in order to figure out how to maximize our profits, we just need to think about what this Q is, right? So how much output we're going to produce. And all we're going to say, this is a little bit tautological, is that the amount of output we produce is just going to depend on the number of inputs that we use, right? So we're going to have a production function or a production technology, right? Both of these terms are going to mean essentially the same thing. We're going to say the amount of output we get is just going to be some function of the inputs that we use. So if our only inputs are labor and capital, we'll just say Q is equal to F of L and K. Now, what's this F, right? What's this function? It's going to depend a little bit on the kind of firm that we are, right? Much like a utility function is going to depend on the type of preferences we have, right? So for a quick aside here on F, all F is really telling us is the amount of stuff that we get as a function of the labor and capital that we hire. So as an example, let's imagine, right, the first firm we're going to look at is a couch moving firm. And let's say in order to move a couch, you're going to need 2 people to pick up the couch, and you're going to need 1 truck to bring the couch, right? You can't replace the truck with extra people, and you can't replace the people with extra trucks, right? So you need 2 people and 1 truck per couch, right? So what's our production function going to be? Well, it's going to be the number of trucks we can move with L people and K trucks. So this is just going to be Q equals F of LK. It's basically going to be the number of couches worth of workers we've got, the number of couches worth of trucks we have, right? Whichever is less. So we'll have the minimum of L over 2 and K. Why does this make sense? If I have 2 people in one truck, I can move 1 couch, right? Because I've got enough people to move 1 couch, enough trucks to move 1 couch. If I added a 3rd person, still move 1 couch. I just have 1 person sitting there with their hands in their pockets feeling silly, right? I have 8 people and 3 trucks. I would have 4 people's worth of, I'd be able to have enough people to move 4 trucks, enough 4 couches, enough trucks to move 3 couches. So what would I be able to move? 3 couches, right? 2 people with their hands in their pockets. Make sense? And then, so this is one version of production technology, right? In this case, we've got labor and capital that are perfect complements, but we can have other production technologies too, right? Let's say instead of being a couch moving company, let's say I'm a grocery store and I've got automatic scanners and I've got cashiers. Sorry, number 2, grocery store, right? So I need, in order to process 1 order's worth of groceries, right? I either need 15, a quarter of an hour of a person, or half an hour of a scanner, right? Because they're slow, nobody knows how to use them, it's a big mess, right? And we'll abstract away from the fact that you normally have to have a person guarding the scanner and fixing things, all that sort of stuff, right? So in this case, how many orders of groceries am I going to be able to scan with L workers and K machines? Well, I'm going to say, well, if I had, let's say, 1 worker, they could scan 4 pallets of groceries, right? So it's going to be 4 times L is the number of orders that people can scan. How about the scanning machines? Well, I can scan 2 orders of groceries for each scanner, right? So plus 2K. So in this case, we would have labor and capital that are perfect substitutes, right? Again, much like with utility functions, we've got production functions here, where the shape of this production function, the relationship between labor and capital, depends on the specifics of the business. Now, an element that's true of production functions that doesn't matter for utility functions, though, is that these Q's, right, these numbers, are actual real numbers, right? If I multiplied this whole thing by 8, I would change the meaning of my production function, because I would say that I'm getting a lot more groceries than I did before. So once I know my production function, then my profit can be written as pi of L and K, right? Profit in terms of how much labor and capital is just going to be the price of my output times F of LK, right? This piece is my revenue minus my costs. Right? And so when I'm deciding how many workers to hire or how much capital to hire, I'm just going to do so to maximize the difference between my revenue and my costs. Okay, wonderful, wonderful, wonderful.